Hey everybody, it's Shamika. Thank you guys for tuning in. Please like, subscribe, and share my videos. I appreciate your support. So this is the third installment in the Be Your Own Bank series, basically giving you guys some ideas on how you can essentially lend yourself money without having to actually use the bank, okay? So if you haven't watched my first two, please go and do just that. Um, just FYI, some of what I'm going to go over now in this video is going to correlate with the infinite banking concept. Okay. And if you guys haven't heard of it, infinite banking concept is basically a thought that I believe wealthy people have acquired, where they have learned ways to lend themselves money without having to go to the bank, which is why I came up with the title Be Your Own Bank. But the infinite banking concept is the same. But the reason that I like the word infinite is because if used properly, you can reuse this over and over and over. So it has infinite possibilities. You have an infinite, and I'm not even sure if I'm using it right, but you have an infinite amount of times that you can go back and reborrow from yourself. So that is what the infinite banking concept is. But since that's too damn difficult for people to remember, just remember, be your own bank. Okay. And if you are your bank once, you can be your bank over and over again if you keep reapplying these same concepts to your situation over and over. Okay. So again, go and check out my first two videos if you haven't, but this is the third installment. All right. So in the infinite banking concept, all right, it basically started out with individuals, with actually one guy who came up with this concept, and his whole message was to teach you guys how to utilize life insurance as a means to get liquid cash. Okay, because you guys know life insurance is basically, it's just sitting there. It's something you pay for every month. It's just the in case of death type thing. So most of us would think of life insurance that we're not going to see the money until someone expires, and that is true in term life cases. But when you have whole life, depending on the type of whole life, you have the ability to borrow once your policy reaches its cash value. Okay, so for example, if you have $100,000 life insurance policy, the cash value may not build up for 5 years, maybe even 10 years. Okay, so this is not one of those short term, put money in your pocket things. This is more of a long term. But the reason that I'm adding this is because you guys know I'm all about being proactive, not reactive, and being strategic and planning for the future, because we are forward thinking people. Okay, we don't like to wait until the bill is due to find out when the money or where the money is coming from. We already like to have this planned out. Okay, so we're going to use this concept, and I'm going to give you a couple ways that you guys can do this. Okay, so traditional whole life. All right, now let me just say, I took the life and health class. I did not take the test. Wasn't really sure if insurance is something that I wanted to do. So I do know a little bit about this. Also, I am a person who believes in the infinite banking or be your own bank concept. And I also use my insurance policies the same exact way in the event I need them. That is the whole point of having them. I think it's a long-term investment. Even if I never use it to get the cash value off, I still have insurance, which means I won't have GoFundMe. Um, and I'll tell you guys a little bit about what I have once I get to some of these topics. But I subscribe to this infinite banking concept, and I highly suggest that you guys do too. If you're able to get one on a minor. Now, we're not betting that anyone's gonna pass anytime soon. Okay, this is all about being strategic. If you do it with a minor, it's cheaper. Okay, a whole life is cheaper for a minor than it is for a 30-year-old. Okay, or older. Again, it takes 5 to 10 years to build up a cash value. You don't have to borrow at that time. You can wait until it gets higher and higher and higher and then borrow. But why not borrow from the account that you had to pay less in to borrow versus us paying however much, hundreds of dollars a month, just to sit around and wait for 5 years to get the money back out. I'd rather do it, if I'm going to do it for 5 years, I'd rather do it and pay the least amount possible, because you're not going to get full cash value of your insurance policy anyway. So you're only going to get a portion. So I'd rather do it and it be cheaper. Okay. So follow me down the rabbit hole really quick. Okay, so we have traditional whole life. All right, so I have some notes here. So it says that you can purchase traditional whole life, which is one of the options that you can do to be able to borrow against. All right, they have whole life policy amounts in different amounts. Okay, so it doesn't have to be $100,000 policy. It doesn't even have to be a $200,000 policy. It could be 50, 25,000, whatever it is that you want. This is just a long-term way of having a savings that you can borrow from or use in the event of an emergency at a later date. Okay, so it says the policy's cash value serves as the foundation for your banking. Duh. And it says it allows you to repay with interest. But the great part is you're repaying with interest to yourself, not to a bank, not into the insurance company, not to anyone, just you. And if I were going to pay anybody interest, I would love it to be me over these banks. So whole life is one way that you can do that. Okay. Now, I'm seeing where it says modified whole life, and a modified whole life is probably going to be an IUL. Okay, I'm not going to get too much into what an IUL is, but IULs give you access to the cash a little faster. The cash value grows a little faster. And let's see, I mean, and you basically would use just how you would use the whole life. It's just another type of whole life policy. IULs are new and they tend to be way more popular than your traditional whole life. Okay, so if you guys are interested in finding out more about that, call an insurance company and speak to an agent and tell them you want to know the difference between an IUL policy or regular whole life. Okay. Let me see. Now, one thing that I like is this is a mixed plan. Okay. The mixed plan is where you could use still whole life, but you also have term life in conjunction. Now, again, you can still borrow from this just like you would your whole life. The only reason why I'm bringing the mixed option in there is because if you're going to have insurance, there's nothing wrong with having term life insurance because it's cheaper. Now, term life you cannot borrow from, but if you are only getting your whole life so that you can use it to borrow against and hopefully one day use it, you might as well have term life also if you can afford it because it's cheaper and you can get more money. Okay, so I'll give you an example. Say, I mean, we don't know when we're going to pass, but say you pass at 70 and you had the whole life and you had the term life. Well, whole life is going to cost a lot more money, especially depending on the age, right? So you want life insurance, so you got it, but you also want to borrow against it, which is why you got the whole life. But you also want to enhance the generational wealth for your kids or for whoever you're going to transfer this wealth to in the event that you pass. Well, a term life is a great way to achieve it. Now, it doesn't give you cash value like the whole life, but it gives you the option to get $1 million policy for probably the same amount that you're paying for your whole life insurance. That's $100,000. Okay. So I like the combination. I personally, that's the one that I use. If I'm going to pass anyway, because we know it's going to happen, I'd rather have the maximum amount that I can borrow on term life. Okay. But I also have a whole life because I want to be able to enact my infinite banking concept, my be your own bank program in the event that, hey, 10, 15 years down the road, I'm in a bad spot and I need to borrow some money. So if you can afford it, I think it's great. Um, Remember, most of you are getting this whole life only to borrow from it later. Not necessarily are you guys concerned with it paying out when you die. Most of you should be. But again, if you, well, not again, if you borrow from your policy, you have a loan out. When you expire, you don't get that full policy. You don't get that full amount. So say you have a $200,000 policy, you borrow 50 grand, 25,000 from it. The insurance company will do its math in the background and it will tell you, hey, because you borrowed this much and this is how much you paid back, this is how much of the policy we will be able to pay out. Okay. Which is why, again, I say have a term life to go along with it in the event um, that you did take a loan out. You know, you want to be able to get the maximum amount that you paid for, but if you borrow, you're not going to get that maximum amount. You know, that's just how it works. Okay. And let me see if I have another option on here too for you guys. All right, so we did traditional, we did the modified, and then we did the mixed where it's whole life and term. Annuities. Now, I know I'm probably not talking to the age bracket that I normally talk to because most of y'all are going annuities, life insurance. We don't have that. But if you are in your 30s and your 40s or older, life insurance is something you should already be talking about or have. But as we get older, guys, annuities are a great way to borrow from yourself. Okay, so basically, I'll give you an example of an annuity that I'm aware of. Say that you are retiring from your job and you may get a lump sum out of your 401k. Let's just say that. Well, with an annuity, you can turn around and take that money and roll it into an annuity, and then they will pay you monthly off of the money that you had. Okay? So I always said if I ever won the lotto, I would put my money in an annuity so that I know that I won't spend it. I will have to wait monthly to get a check like everybody else. And to me, it keeps me in check for some of those people that are unable to. Okay.